Joining me now as we go through your markets, your midday markets analysis, is Viv Govender from Rand Swiss Offshore. Viv, thanks so much for joining us today. Now, global markets kicked off the week on a mixed note after the pause in rates last week from the Fed. Are we just seeing traders remaining cautious at this moment, awaiting that PCE data?
Well, certainly. I mean, the US Fed has lowered the chance of rate cuts, or at least the markets lowered the chance of rate cuts from the US Fed significantly over the period of the last, say, 3 to 4 months. At the end of last year, we were looking at a chance of pretty much 99% we're going to get a cut, by the middle of the year. Now it's closer to about 60 and 70%. There was a significant chance, a probability at some point that we are going to see a rate cut by, basically the next meeting or so. That's, I think, less likely at the moment. And so obviously we need to see some kind of movement from the US Fed, from the data to confirm a cut or not. At the moment, the US economy is doing very well. Inflation is not just not falling towards the target rate or at the target rate. It's kind of stalling out, and there's some indications that it's actually starting to rise slightly. So it's above the target rate, rising slightly. That scenario does not really call for a rate cut. The market, at the moment, I said, is really expecting at least 3 cuts by this year. And so is the Fed, by the way. And
that's what I was about to mention, that we nearing the end of the first quarter and 0 rate cuts like we did, like markets anticipated late last year. Inflation still proving to be very, very sticky, even here at home, proving to be quite sticky. So with that being said, do you also expect Kganyago to keep rates unchanged?
We won't go on our own. We can't go on our own. It does not make sense. You see the Rand at the moment, just below 19. If we basically break with what the US is doing and start cutting, early, we probably see the currency blow up above 20. And if we do see that, that's a psychological level. I think that's going to be very important. Then suddenly the price of petrol, the price of anything import goes up, and inflation becomes a problem. And he's forced to reverse. We can't really forge our own path in this scenario.
And we can't even risk that, especially with risk events like the elections coming up as well. Now, let's get into some company news now. Viv, EOH out with numbers. The group is still in the red, even though there's a slight improvement in the headline loss per share from 17 cents to 11 cents. What have you made of those numbers? And the group did cite, those tough trading conditions as a result of this performance.
Yeah, look, I mean, EOH is a company that's been in trouble for quite some time now. We have seen basically the CEO exit. The business is under considerable pressure, as it's been reported on. If you look at at a business that's not doing well in a market that's basically not supportive of it, the fact that we are seeing, some businesses I always mention ShopRite doing excellently well in a market that does not really support it, still just barely eking out, returns that are comparable to bonds for the last 5 years. We have a situation like this year, and the possibility of a capital raise as well. I think is the raise that they did. Also, I think it really hasn't really gotten fully back on track at the moment.
And I guess we're just waiting to see how everything follows through. As Stephen did say, it is kind of geared for growth moving forward. Now, a company that's managed to somewhat weather these tough trading conditions is Master Drilling. Record revenue growth in HEPS, as well as it leveraged off an established client base and its global presence. Take us through your reading of those numbers.
Yeah, look, according to them, they are very, buoyant on, Africa's prospects. There is, obviously a lot of opportunity in Africa. Africa, despite the perception many people may have, is one of the least explored continents when it comes to, mining, and therefore we are seeing, opportunity out there as we do see a greater, exploration happening. I do think that, the overall resource sector at the moment is under a bit of pressure due to what's happening in China. China has a huge source of demand beyond what their GDP would indicate for natural resources. Especially that they're building property sector, which is the most badly affected sector at the moment. I mean, you're looking at like a third of the mainly based raw materials are going directly into building property in China from the Chinese demand. And Chinese demand in often cases is 40-50% of global demand. So I do think the longer term issues are problematic for resources. But Master Drilling, like you said, looking quite good at the moment, and they are exploding. And like I said, opportunities that may in the long term provide a nice high reward, profile for them.
Let's move over to the retail sector. SPAR's updated markets. It cited tough conditions across all its regions. Consumers dealing with high inflation, higher interest rates. It's not a surprise. What's your sentiment around SPAR and these grocer retailers? I mean, you mentioned ShopRite, who's actually eating everyone's lunch at the moment.
Yeah, look, ShopRite has been getting market share for 5 years in a row, effectively. And like in the 5 years, I said, they aren't even getting like close to double-digit average returns. They are getting close to, but they aren't beating it. Double-digit, annual returns. They are obviously the gold standard in the sector. As far as issues in international markets, there's been difficulty there. Even local markets as well. Some of the operational stuff they've had on IT, etc., has been troublesome to say the least. At the same time, I think that the whole retail sector at the moment, is in a bit of a turmoil. As far as say, they're saying sales, rose 5.8% for like and like, but obviously, tourists, they are being affected negatively by tourist exchange fluctuations. But if you look at the whole retail sector, the stuff that 60/60 is doing from Checkers or ShopRite, that stuff I think is going to really change the way this market looks in 5 to 10 years' time. I think 60 is growing at about 60 something, almost 70% a year on year. I think that's going to be bigger and bigger over time. That's going to change how we behave. Spas tend to be smaller. They tend to be basically more convenient. Just go closer to a small spa as opposed to a massive, ShopRite or something like that. There, it might be usually bigger. But if you're having a case where you have the 60/60 and you have somebody else doing the traveling for you, you may not care as much if the guy travels 1K or 2Ks more to get to your house, as much as you would care, for instance, to drive 1-2 more Ks to get to the ShopRite Checkers or whatever it is versus the spa. And I think that's going to really change the makeup of the retail sector in South Africa going forward.
What's your sentiments around Pick n Pay? I know it's going through some troubling times, but I mean, with Pick n Pay apps ASAP sort of picking up and leveraging off that partnership they have with Mr. D as well. What's your sentiment around Pick n Pay?
Pretty negative. I mean, if you look at the share price over the last 5 years, it's down 72%. And I was complaining about ShopRite not doing double-digit growth rates, annual growth rates. It's better than being down 72%. More than 2/3 of the last 5 years. Yeah. Look, I think the thing that you must understand is that these businesses like ShopRite and Checkers and ShopRite Spa and Pick n Pay and those kind of guys are effectively logistics businesses. I mean, you can go into a Spa, you can go into a ShopRite, you can go into a Pick n Pay, and yes, there'll be a couple of store brands here and there, but that's not what you're going to buy usually. You're usually buying, stuff that's available at each of them. You're buying your Nestle's, you're buying your Beacons or Cadbury's. They're going to be in every shop, you know what I mean? Those chocolates are not going to be specific to any particular shop. So in that scenario, you're going for the cheapest, the most convenient, etc. And it comes down to the logistics of how cheaply and how easily can you get into your shop, what price, what margin can you live with, etc. And unfortunately, small, makeshift things when it comes to delivery are not going to work as well as a properly designed delivery system. Because, I mean, every cent, every percentage point in efficiency makes a huge difference at the end of the day.
All right, let's hit the brakes on that conversation. Now, before we head to your stock pick, let's reflect on some of the counters that have found favor with your industry peers.
I've been hammering on this one for a while, and I still think, emerging markets in general are showing, very, very good entry valuations over here. If you just look at sort of the index as a whole, yes, it is dominated to a large extent by China and India, which are obviously at the polar opposites at the moment. India is trading at very high levels. China has been under a lot of pressure. But, I just think on these valuations, you've got to go EM. If you just look a little bit more in depth on, what sort of the makeup or the composition of the index is, you're getting great companies like Taiwan Semiconductors. Those are all ways of accessing the semiconductor, the chips index without necessarily paying eye-watering valuations like for NVIDIA. There's a lot of financial services in there, and, you just get a good diversified exposure. So I think any investor portfolio would benefit from having exposure to them. So mine is the iShares Global Emerging Markets Index.
I'm going local today. SA Inc. stocks, as we were chatting about a little bit earlier, are generally on the main incredibly cheap, but there is a lot of risk attached to them because of the macro environment. So our sense is you've got to buy the strongest in the sector. So we're looking in the industrial sector, a company called Hudeco, and they've really been one of the most consistent and probably financial strong operators in that sector. They supply industrial, automotive, and electronic consumables, mostly into the South African market. Yeah, I think what we like about them, financials look really strong, nice balance sheet, good cash flow generation. They've got nice pricing power on the brands that they import. So, they're able to weather some inflation. And their business model now is really growing by acquisition. So they're picking up some of their struggling competitors, and we see at a kind of a 7 earnings multiple, some nice upside from here.
I'm going into technology offshore, and one of the magnificent seven, to give you an idea that I don't believe the bubble is over in that sort of sense, I'm going for Amazon. It's a company that I think has been historically grabbing a lot of market share, but generally not that profitable other than in their cloud sort of business. And I think under the new leadership of Andrew Jassy coming across from the cloud business, which is a very profitable enterprise, I think there's certainly much more of a clear driver towards just trying to take revenue and market share. They're moving away from that, and I think they're moving towards profitability. So I sort of anticipate they can grow earnings at least 30% a year for the next 3 years. And it's not on a demanding kind of valuation relative to itself and even relative to other sort of tech companies that are out there. So that is my stock pick. I still think there's a lot of juice left in that sort of stock. And, it's not even close to bubble territory for Amazon at the moment.
So let's get your thoughts on those counters, particularly the opportunity that Jacobus is seeing in EMs as he picked the iShares MSCI EM Index Fund.
Yeah, look, as you mentioned, China plays a big role in that. It depends on your outlook on China. I'm a bit nervous in China. There's opportunities in some places, especially in the internet sector. That is, I think some of those stocks are really overdone in terms of their sales, and therefore you might be attracted there. But overall, you still have to worry about the property sector. You still have to worry about the overall health of the Chinese consumer, which, I think is going to be something difficult, because if you think about the fact that the property sector in China accounts for something like about 70% of personal wealth of the country, 30% of the GDP of the country. It is, a disaster of note that we are seeing what's happening there right now with the defaults, with the ghost cities, et cetera, et cetera. So that's the only nervousness I would have. I think overall emerging markets are good. My nervousness would be around particularly China. With regards to the others, Hudeco, I would be nervous about South Africa. I'm not a big believer in the South African, recovery story at the moment. I think there's, many fundamental weaknesses right now. I think there's more opportunity offshore. And with Amazon, I'm more positive on. The only thing of nervousness in Amazon I would look at is the fact that you look at the Apple's lawsuit by the DOJ recently, where the DOJ went against the US government went against Apple to try and look at its monopoly. If it succeeds with Apple, I think Amazon is definitely next to that list. What Amazon is doing in retail is, to a certain extent, something you could term monopolistic, or at least very aggressive. Some of their strategies, some of their tactics they've used against suppliers that have used their platforms and their pricing rules, etc., with things even like the Kindle, etc., is very, very, I think, anti-competitive. And if Apple is facing problems because of the green versus blue bubbles you get when you make iMessaging, trust me, Amazon is going to face much more difficulties going forward from the US government.
So mixed reactions on those stocks. What aren't you mixed about? What is your stock pick? We have about 30 seconds.
I'm on Tesla. The price has come down significantly, and I think Tesla is one of the magnificent seven that's been really badly over the last little while, partly due to Elon Musk and other issues. But I think they are set to, they just released the full self-driving, the largest version that apparently is very good. And I'm quite positive of the company going forward from here, especially the stuff around self-driving and even the other stuff around AI as well.
Viv, let's leave it there. Thank you so much for joining us today. That was your midday market update with Viv Govender from Rand Swiss Offshore.